Here's the script for your video. Why do LPs reject funds that are already oversubscribed? Written in an emotionally intense, simple, and engaging style. Look, it's tempting to think that when a fund is oversubscribed, when everyone's scrambling to get a piece of the deal, that this has to be good news for you, right? Everyone wants in, the fund's hot, the momentum's pumping. But here's the brutal truth that hardly anyone talks about. For a savvy limited partner, an oversubscribed fund can be one of the biggest red flags out there. Yeah, sounds crazy, but stay with this, because it cuts deep and it changes the way you have to approach investing forever. First off, think about what oversubscription really means. It means the fund has raised more money than it initially wanted. More people want in than the fund can actually take. Sounds like a win, like the fund's got this massive demand. But in reality, it's a sign that things aren't as straightforward or as ideal as they seem. And that oversubscription can create problems that hit you, the limited partner, hardest. Have you ever sat back and realized that when a fund is oversubscribed, it usually means one thing: the fund manager is swimming in capital. Too much capital, actually. That might sound like a good problem to have, but here's the catch. It means they might be raising more money than they can effectively invest. Too much cash chasing too few good deals. And guess what? That's how returns get diluted, how good money turns into mediocrity. You want your money to work hard. You want it directed, sharp, laser-focused on outstanding opportunities that actually change the game. But oversubscription often means the fund manager is under huge pressure to put all that capital to work, fast. That pressure doesn't come from thin air. It comes from you, from the investors, from the market hype. And it can make them take shortcuts, invest in less than stellar deals, or even bend their own rules to keep the money flowing. Imagine the frustration of being locked into a fund where the supposedly brilliant investment thesis starts bending because the manager can't find enough top-tier deals to fill the stack of commitments. It's like a chef who has more orders than the kitchen can handle and starts messing with the recipe, swapping out premium ingredients for cheaper ones without telling you. You end up with a meal that doesn't taste like what you signed up for. Then there's the due diligence factor. When a fund is oversubscribed, it often means the manager has less time and less incentive to dig deep. Why? Because they're focused on closing the round, making sure everyone's checks clear, juggling commitments, and handling the chaos of oversubscription, instead of vetting every opportunity with the rigor it deserves. This rush can lead to compromised due diligence, and you as an LP are the ones taking that risk. You deserve better than rushed decisions and watered-down deals. You deserve a manager who says no to excess capital, who knows their limits and understands that it's not about how much money you raise. It's about how well you invest what you have. The best funds out there, they're disciplined. They don't chase fundraising milestones or status. They chase results. They value quality over quantity every single time. It's also critical to understand the psychology behind oversubscription. Often oversubscription isn't just about real demand, it's about perception. Fear of missing out, hype, chasing the next big trend. But look, as an LP, panic and herd mentality are your enemies. You must be the voice of restraint, the one who questions the frenzy instead of joining it. Because the truth is, when everyone wants in, the best place to be might just be outside that rush. Plus, the moment a fund is oversubscribed, your leverage drops dramatically. Before, you could negotiate better terms, demand more transparency, or carefully choose your allocation size. After oversubscription, pow. Your power wanes. You become just another check in a big pile. your clout diluted, your influence limited. That's a loss you can't afford if your goal is to protect and grow your capital with intention. What's the solution then? How do you turn this headache into an advantage? Simple but rarely practiced. Patience and selectivity. The best LPs don't rush to jump on the bandwagon. They watch, they wait, they dig deeper. They look for funds where the managers have a clear plan to deploy capital painstakingly, where the pipeline of deals is robust and proven, and where the fund size is just right. Not too big, not too small. They align with managers who respect scarcity because scarcity means value. Also, always look beyond the headline numbers and hype. Oversubscription numbers alone don't tell you the full story. Dig into how the fund plans to invest that capital. Ask the hard questions. What's the investment pacing? How many deals have they underwritten so far? What's the track record on exits and returns? How transparent is the communication? And how committed is the manager to sticking to their strategy even if they can raise more money? These questions separate the pros from the hype. Another layer most LPs miss is the impact of oversubscription on fund dynamics. More capital means more investors, more relationships to manage, and more conflicting interests to balance. This often translates into slower decision-making, diluted reporting, and potential misalignment of incentives. You want your fund manager laser-focused on maximizing returns, not caught up in managing a bloated list of stakeholders. Listen closely. Rejecting a fund that's already oversubscribed isn't about missing out on an opportunity. It's about protecting yourself from settled compromises, hidden risks, and average outcomes parading as wins. It's about being ruthless with your capital, making sure it's committed where it counts, and demanding that your partners respect that standard. You've probably felt the internal tension, wanting to say yes because the perceived momentum feels right, but something deep down keeps you cautious. Trust that feeling. That tension is your insight sharpening, your instincts reminding you that oversubscription is often a warning sign wrapped in glitter. At the end of the day, your role as an LP isn't to be swept up by the crowd. It's to be the guardian of your capital, the critical thinker who doesn't just follow the loudest voice, but listens to the whispers beneath the noise. Rejecting oversubscribed funds sometimes means standing firm against the tide. But those moments build the foundation for truly transformational returns. If you can resist the urge to jump in just because everyone else is, you'll reward yourself with partnerships that value discipline over desperation, depth over breadth. You'll back managers who choose a smaller, sharper fund over a bloated one. You'll be part of a story where patience fuels power, and power fuels legacy. Think about it this way. An oversubscribed fund is often a sign that the system is rewarding noise, not essence. It's saying, come on, just get in while you can. But the few who say no, who demand quality, who wait for the right seat at the table, those are the ones who change the game. So next time you're faced with a fund that's flooded with capital and bursting at the seams, remember this. Saying no isn't just rejection. It's your declaration that you're here to play a different game, one where your capital drives transformation, not just volume. Hold fast to that feeling in your gut. Invest with intent. Choose wisely. And watch as the noise fades and the real opportunities rise. Because that is the power of discipline and true partnership. That is how you own your future as an LP. If you want, I can help you tweak this further or adapt the tone. Let me know.